This episode is sponsored by Lloyd's Register, a trusted partner in the evolving energy landscape, and EIC Global Platinum Partner. As the world works towards net zero, traditional fuels like oil and gas will remain essential in meeting global energy demands. Lloyd's Register supports operators across the energy spectrum, helping integrate renewables, hydrogen, nuclear, and carbon capture to existing systems. Their deep expertise ensures safe, efficient, and sustainable solutions across the full energy value chain. Backed by the Lloyd's Register Foundation, they provide independent guidance to help businesses make confident, future-ready decisions. Learn more at lr.org/energies or connect with the Lloyd's Register team in person at an upcoming EIC event. Hi everybody, this is Stuart Broadley from the EIC and welcome to another EIC Survive and Thrive podcast. This is the 2026 or the 10th report edition, where we are delighted to have published the new edition of the Survive and Thrive report, which has all sorts of interesting insights in it. But of course, most importantly, it showcases 136 member stories, members all over the world of EIC who have talked once again about the strategies they're using to survive and or thrive, but most importantly, generally to grow in what continue to be very challenging markets. Actually, my colleagues and I, over the last 10 years, have interviewed now 700 companies in this Survive and Thrive process. So it's been an incredible piece of work. It feels like a PhD every year when we do this. We're so excited to have a new report to talk about. So some stats, it's 136 companies, as I say, this year, all over the world. In basic terms, 30% in the UK, 15% in the Middle East, 10% in the Asia-Pacific region, 20% in continental Europe, 5% in South America and 10% in North America that are member companies that have participated. And today, I'm delighted to have Ryan McPherson, who is our Regional Director for the Middle East, Africa and CIS, and Kim Stephen, who is the Regional Director for UK and Ireland, who did a lot of the interviews. And you've got me. I did the Continental Europe interviews and some of the UK interviews. So between us, we think we've done about 75% of all the interviews. So we're going to have a go now together discussing some of these key findings. I hope you find this useful. So Ryan and Kim, hi, how are you?
Hi, good, thanks, Stuart. How are you?
Well, I think like everybody, very pleased that this Survive and Thrive process is coming to an end because it's a huge amount of work. I love it. It's my favourite thing, but I'm also so delighted when it's finished for another year and I can do other stuff.
Absolutely agree. It was a busy start to the year with a lot of Survive and Thrives, but nice to be talking about them now that the report is about to be published.
I actually strangely miss the interviews now because we concluded about 2 months ago. So I think you kind of to miss them because there's a lot of good content, as I'm sure Kim and yourself will discuss as well, Stuart.
I mean, they're just great long form conversations with our members, aren't they? So we learn so much. It brings us closer to the work they're doing and to the people who are the leaders in those businesses. So it's just valuable information for us. And by knowing our members better, we can then hopefully point them to the information they should be aware of, the people they should be meeting and helping them with decision making. So I'm going to go through 6 of the many, many high-level findings that are covered in the report. Our particular focus today is not really to repeat what's in the report, but is to bring them up to date in terms of what's happened since the interviews were done, because the interviews were done between January and May 2026. And a lot has happened since we started the interviews. Some of the interviews were being done even before the US and Israeli war with Iran, and all of them were done before it was known about what was going to be the outcome of that war. We'll be talking about what's changed, but I think generally we're going to try and work out what this might all mean for the rest of the year. Let's start then with growth. So we already know 2025 was expected to be a growth year. In the report this year, we asked companies what their actual growth was in 2025, and it was 23% average growth rate across the supply chain. So you would say another boom year last year. For all the struggles that we hear from different companies, they are still growing fast. I mean, 23% average growth rate is by far much faster than the inflation rate. And 91% of those companies expected further growth in 2026. And when asked, they forecast the growth rate in 2026 to be 32%. So even more growth rate this year expected. Now, as I say before, there's a health warning about that because obviously the war in the Middle East might have changed that. So I think let's start with that. Ryan, what are you hearing today around companies' views on growth in the Middle East particularly?
Yes, sure. I think you highlight very well. When we started the interviews and during the course is when we actually entered into the conflict at the end of February. So there was a little bit of a change perhaps in the viewpoint of many of our members. But at that point, the consequence was not known. So many of our members in the interviews were still extremely optimistic. Wasn't really the timeline that was known. So the first few interviews taking place January, February, very bullish. I think afterwards we started to get feeling maybe this isn't going to be as strong a year as we've originally forecast, and particularly towards the end, you could see some companies who had already started to reforecast there. The figures you just provided are very interesting, and I think that's where companies felt at the time when they were doing the interviews. Fast forward perhaps to where we are now, the dust is settling in the region. I think there is more optimism than we had 2-3 months ago, but I think a lot of the companies have still had to scale back original forecasts, certainly for this year, but if anything, they've been pushed back a year. Everyone is expecting 27 and beyond to be very much that boom year as everything makes up for perhaps the last 3-4 months that slowed down in the region.
Have you seen companies exit the region, or they've just had to wait and it's sort of almost in that sort of COVID feeling of we have to wait for access and travel and offices to be open again so that we can get going again?
We've definitely seen that muscle memory from COVID, and thankfully no companies that we're aware of have exited the region during that time. I think they've realised the buoyancy that's built into this market. They've done the hard work in setting up and establishing a lot of the relationships here. So it's almost a wait and see as the market picks up, but there was no real retrenching. Perhaps maybe a bit of right sizing in the business, and a few pivot people were looking at different parts of the world, but still servicing that from this region. So the positivity remain, and that should provide dividends for the companies that have stayed the course here. So nobody exiting during that time.
There were some nerve-wracking moments, weren't there, though? I remember when I was talking to you when we were in month 2 and month 3, it's like, oh no, where is this going and what's going to happen if this doesn't end? So thankfully now we have a ceasefire negotiation continuing on, and both parties seemingly determined now to get to peace. So let's hope that's what the outcome is. Kim, let's come to you then. So what are you hearing about your members in the UK and their view on growth?
From a UK perspective, I was fortunate enough, as you mentioned, to speak to a number of companies, and we know that many of them have a global outlook on business generally. They were looking at future growth for future years, but perhaps with a degree of caution. There were very much projections on future growth, but they were aware of tough times. Now, a number of my interviews would have been pre the conflict. I think I started back in January, so I've probably done quite a few news of that. But I would say the growth that members in the UK are identifying is around sort of overseas and export growth due to the current sort of UK energy landscape being as it is. So we know our government's position, the oil and gas side of things, and whilst renewables and energy transition, we have targets in that regard, perhaps businesses aren't seeing that filling order books to the degree that they would like.
Just for people listening from around the world who may not know much about UK policy, so to be very clear then, so we have a Labour government who their manifesto included ending of all further oil and gas licences in the UK sector of the North Sea. And they've carried through that. So they're now in year 3 of that policy. So obviously that's affecting the UK supply chain, which is predominantly reliant on oil and gas for its work and has always been a heavily export-focused supply chain. And as you say, are switching more and more to that with less and less domestic oil and gas work, which is very sad. And none of us particularly happy with that approach. But we do understand that it's all about aggressively transitioning to the renewable and transition economy. And it would be fine if those projects were coming fast enough and if there were enough jobs coming from those projects. But I think that's what you're referring to, is those projects are getting delayed. And even when the projects do come, there aren't enough jobs, anything like enough jobs to fill the gap in oil and gas terms. So I guess in summary, companies are still growing, but not from domestic work.
Yes, absolutely, Stuart. They would love to be doing more business on the domestic market for sure. Our members would be delighted to be doing more work on UK home soil.
So let's then go to the second key finding, which is about the use of AI in our member companies. We did ask companies how many are currently now using AI in their business. of which 90% said they are now using it in their business. By far, the majority are using it just for their internal use. So optimization, efficiency, process, governance, document checking, and so on. Not many yet are building AI into their customer-facing products and services. That sounds encouraging. I think also 45% of companies surveyed said they now are having some revenue, although not much yet, in data center work, particularly the power for data centers. So that's new. And it's happening quickly around the world, and our members are already seeing some upside from that. But what really I think is important is that although everybody is now working on AI and seeing that work coming through, it hasn't really made any difference yet to the number of companies that would say their growth story is about AI yet. So overall, we've had for the last 6 years a flat level of percentage of success stories linked to digital and AI in this sort of 15% range of stories linked to that. No change. So I guess the point is lots of opportunities and work being done in the space, but not yet leading to any significant value. Kim, what are you hearing about that in the UK?
Speaking to a number of different companies, where elements of ways that they were working, tools that they were using in relation to AI. I would say that there were a greater number this year that I spoke to personally that has an element of that within their story. However, I recall one interview in particular towards the end of my interview set where the company actually was quite keen for it to be a transformation story because it had been quite a journey that they'd been on to improve efficiency in their business, to develop ways of working for their traditional sort of services that they offered their clients. But actually, the change management and the transformation that meant within their sort of operations was quite significant. I can see where the data might state that the success story itself is not specifically digital. However, I think it's perhaps the way in which some of the companies might be using the tools in order to build resilience in their business and optimize their operations as well. So certainly some interesting things sort of being done by some businesses that I spoke to in that space. A lot of companies there, when they talk about what they use internally, what they use externally, I would say that even when digging a little bit further, those companies that say, yes, I use it. We use AI. Actually, when you got into the detail of it, perhaps not as many had a formal strategy, was perhaps used across their business in sort of a light touch way, but there was definitely an appetite for the business to be a bit more sort of structured in that space. And I think there's a growing appreciation of the improvements that could have within the businesses themselves.
Companies are in a steep learning cycle at the moment, aren't they? At EIC, we'd have to say we're the same. We're encouraging staff to look at the tools, but really we're specifying they should do it around a clear purpose that benefits ourselves and our members and the core processes linked to that. So we're trying to control it so it's not just a token frenzy. A lot of companies are making the mistake of kind of overspending without any clear understanding of why. What are you hearing in the Middle East, Ryan, about use of AI?
I found this a really insightful part of the discussions, and probably to echo what Kim has said, that many of the companies talked about it, but it was very much used on a marketing perspective or polishing emails using sort of your generative AI. But where I've definitely seen, I think we're probably just 12 months ahead of the curve with this question, Stuart, because I really feel that when talking to a lot of the members, there was that structure being put in place just now with very much doubting you would get the same answer 12 months down the line. I think we'll see more robust procedures put in place and companies will look to monetize this in a bigger way across their organization. So I found it very interesting there. And it doesn't surprise me, the high figure, that 90%, but not really making it work in their organization. The data centers was interesting because I think 12 months ago, this wasn't really on anyone's lips. I had one story with Kent, which was specific on the data centers, really fascinating for anyone reading the report. I look at all the stories, but definitely this one. We had one other company that talked about their diversification. It was almost a throwaway comment about, well, we're also doing work in data centers. It's generating revenue. We're seeing year-on-year growth. This actually kind of got us and EIC wider in the region thinking, and we've since done events specifically on data centers. So again, I see that as a growth area in 12 months' time. So a really interesting insight. I just think we're 12 months ahead of the curve on that.
We'll wait and see on that. I think we used to say the same about digital and digital twins, and we expected that to become a dominant sort of growth strategy, and it never really grew above about 15% of the stories linked to digital. And now AI has come in as a digital AI category. So far, no change on the needle. Let's see. Hopefully, it will bring that change. And I guess EIC, we hopefully also see the value from it in the next 1 or 2 years as well. Okay, great. Let's go to the next point with them, which is the continued dominance of, guess what, oil and gas. And this is kind of one of those things where it's not always a popular thing to say, but we're just here reporting. I just remind everybody listening to this who might have a view on which energy sector they advocate for. We don't advocate for any one energy sector. We advocate for the supply chain, and we look at all energy sectors on an agnostic basis. So we just report the data as we see it, right? So the data is this, which is 94% of the companies we interviewed are still active in the sector, which on average 59% of revenues for the 136 companies is linked directly to oil and gas work. That is what it is. And it hasn't really changed over the last 5 years. That sort of 55 to 60% of revenues linked to oil and gas has been consistent over 5 years. So far, the obvious growth in renewable projects in some parts of the world, not all parts of the world, which is impressive, has not led to a change in percentage activity of revenues in the supply chain. And you could probably argue it's because the overall energy demand is growing, so there's a need for all technologies. And although oil and gas is an important part of the mix, maybe renewables is also important. They're all important right now, but overall, oil and gas still is dominant as the play. Ryan, obviously in the Middle East, you sit amongst many petrostates, maybe states that don't want to be called a petrostate anymore. What are you seeing?
Oil continues to dominate. I think you're seeing our supply chain is very much like ourselves. They're energy agnostic. Even ADNOC in the region, the National Oil Company, is a great example of a company that's diversified. And in fact, we're seeing a lot of energy transition, renewable projects happening across the region. But going back, oil is still going to be the dominant energy source for probably years to come. We're seeing things like the UAE decided to step out of OPEC. And what that means is they'll increase their production. Other Gulf states, I think, will follow suit in terms of increasing production as well. And this was very much a comparison from a few years ago when we were conducting the Survive and Thrive interviews. When we were asking the energy mix in the business, there was almost an apology that we weren't doing more in renewables. And I found this year that was completely gone. Completely gone. They didn't feel the need to, this is what we're working on, this is what keeps the lights on for us, and this is what we're good at. That narrative had changed for me in the last 12, 24 months. So quite happy to see the majority of our work is in hydrocarbons, oil and gas, and we want to continue to increase that percentage. But if work comes along in renewables and we are the right company to do it, we'll also diversify or move ourselves in there. That was one key takeaway from me. No need to apologise for what you're working on.
And Kim, obviously for you, you've already talked about how you have an oil and gas heritage supply chain in the UK, which is having to look overseas in order to win enough work to keep itself busy right now. But overall, are you still saying that those companies still lean on oil and gas, or are you starting to see them just exit oil and gas and go into other sectors? Because the data we're seeing says, no, they're still as reliant on oil and gas as they ever were, albeit it's not in the UK right now.
This is the third year that I've been involved in Survive and Thrive. And I think for me, in that first round a couple of years ago, I found that companies were sharing stories of diversification. They were talking about different industries and talking about how they were really keen to share success stories in different parts of the energy mix. I would say last year, I found that story came out quite differently in terms of diversification. And it was very much, they did not want to forget their history and their heritage. And they were very proud of that in the oil and gas side of things. And for me this year, that message was strong once again. So really agree with the points that Ryan made on that side of things. They value it. There are strong profits in buoyant markets. We know that many of our UK companies we are sending regularly to Ryan and his team, looking at sort of exploring new regions or growing in different parts of the world. And very much the Middle East has been a focus for the UK-based companies that we've been dealing with. I agree that the reliance and the importance of oil and gas remains for the UK members, certainly.
Yeah, and actually that was one of the oddities about this year's research compared to last year. The 2025, the 9th edition of Survive and Thrive, the main finding was that companies are all looking for work in the Middle East. It was regarded as the best market to be in, and amazing number of companies were knocking on your door, Ryan, saying, how do we access this Middle East market? So it's a shame what's happened in the Middle East in the first half of 2026 with the conflict and absolutely turning off the tap of work and travel and optimism. And now that we have a ceasefire, let's hope that optimism returns. If you're enjoying this podcast and think you have an inspiring story to tell, contact me, Stuart Broadley, directly, as I would love to do a C-Level podcast with you too.
EIC is proud to be the UK's largest membership energy trade association and the 5th largest in the world. We are unique around the world for 3 reasons. We are truly energy agnostic, believing all energy technologies are vital to delivering energy security, affordability, and a just transition. We are the only energy trade association anywhere in the world that offers a truly in-house one-stop shop for market intelligence, networks, and events to help our members export, diversify, and grow. And we are proud to be the voice of the energy supply chain, advocating for the 5 golden rules of a healthy energy supply chain. More details on EIC membership, the 5 golden rules, details about doing a future podcast with me, and how to contact us about anything else are in the description for this podcast.
So Kim, carrying on with you then, again, building on this exports topic, the next key finding is, I'm afraid, a very sad finding, a truism of what it's like to be in the energy industry globally. This isn't just a UK point, actually. This is true about companies all over the world in the supply chain, which is for the 10th year in the row, would say the hardest growth strategy, and therefore the least used growth strategy that our research has shown is to develop new export markets. It's just so frustrating. If we as EIC, we define ourselves as we're here to help companies export, diversify and grow, and yet developing new export markets is still by far the least used growth strategy, and it hasn't changed at all in 10 years. So although, Kim, you're saying rightly so that companies are still strongly exporting to their established markets, they're not taking the time to develop new markets. What are you hearing about why that is?
The export piece, certainly from the UK, I remember speaking through different regions as to where they're focusing on and why. And quite often for those UK-based businesses that have such a global outreach already, they're looking at growing in existing markets. And it's ultimately about costs, about risks, about making sure that they have the correct partners, and I guess the risks that potentially are involved in setting those up. So I guess for members here, they're looking at where there is less risk associated with those existing growth markets rather than entering new. The whole export piece for those businesses based in the UK is around the fact they are limited on the domestic work, or indeed have seen the domestic work reduce over the last couple of years, and are therefore, focusing more on growing in exporting markets. I think it's important. We are seeing companies remain in the UK, which is positive currently. We certainly want to make sure that they're rooted here in the UK, but sort of exporting their expertise into different parts of the world. I hope that remains, but it is a concern in terms of making sure that we keep those businesses and that expertise in the UK whilst they grow internationally and domestically.
Yeah, Ryan, I'm interested then in the Middle East perspective on developing new export markets, because as I've inferred before, the Middle East is historically seen as one of those go-to export markets, and most companies developed their capabilities there 20, 30, 40 years ago, and they're just continuing to harvest from that investment they made a long time ago. I think there's some crazy stat like 200,000 British expats just in UAE. I think it could even be 300,000. I mean, it's crazy, not just in the energy industry, but in other industries too. So it's not just about exporting, it's actually international trade and localized business as well. What are you seeing as the Middle East approach to developing new export markets?
Yeah, so go back to your first point, and I think it's something that EIC probably long before my time is very proud of. The companies that are here that have been set up, EIC had helped them, but you're right, it's 20, 30 years ago when this was considered a bit of a frontier market for many companies, and they've now established the barriers to entry are now a little bit higher. But we still know that companies want to come out here. So the likes of doing your in-country value score, your localized manufacturing that's come out. But the biggest export has always probably been from the UK people. And you mentioning there, Stuart, the amount of people that are coming to the UAE and further afield across the GCC to work, whether for existing companies or different companies to increase their lifestyle or perhaps the opportunities experience. So you're seeing a big exporter of people. We are still seeing companies come out, but the second part of your question is, I think we're seeing companies look to do a little bit more from the Middle East. A great example, you're seeing companies that are now doing the Make It in the Emirates, and then they're exporting and are encouraged to by the government as well. The governments here have mandates to try and get you to export elsewhere. So there are companies that are making products, UK companies, EIC members, making their products in the UAE and then exporting elsewhere in the GCC or elsewhere. That's a trend that we're starting to see encouraged. I can't say I have the stats at hand, how many are coming through, but that is a big area. And that UAE branded stamp made in the UAE is a big thing now. So that's maybe a trend that we'll see in future years from our members.
Yeah, this kind of national priorities around local content, and it's really generating fast-growing economies. A number of jobs is growing. Diversification of the economy is growing across these old petrostates, if you want to call them that are no longer really petrostates by many definitions. I know in the UK we look enviously on at the level of economic growth, but also at the ability to set these UK content. We don't have a UK content ability, either through policy or legal restrictions. I know our members wish we did. Okay, so let's move on then to the fifth of our six key things we're going to talk about today. One of the things that's just obvious about 2026 is, on the one side, supply chain companies are generally doing well, but on the other side, they're feeling very skittish. They're feeling very anxious about what the future holds. And this is holding back future investment. Whether you're a supply chain company or even whether you're an investor, how do you make an investment decision right now with so much uncertainty, geopolitical uncertainty, trading uncertainty, tariffs, logistical routes, and so on from companies in the Middle East? How are companies balancing keeping going and taking opportunities of what we expect 2027 to be, which is a boom year in the Middle East, with reconstruction and new projects, alternative routes to get oil and gas flowing and so on, but feeling that where's the next crisis going to come? It could be tomorrow.
Not surprised by this finding at all, and it's probably the conversation that dominates everything at the moment in the supply chain. As mentioned, since the start of the conflict, we've seen a change in the way that businesses have run themselves. A lot of projects have slowed down. There's been an emphasis on the rehabilitation, and understandably, that takes a bit of time as well. Like, the conflict carried on for longer than was expected, and companies were hanging on in there. Nobody knew how long that was going to be. So I think there is that cautious approach, and it still sits in the market just now, Stuart. The double-edged sword is, and you allude to this, the rehabilitation work, these projects aren't going to go away either. If we look at ADNOC talking about a 200 billion dirham spend, so about 50 billion US dollars over the next couple of years, companies want to still be in the game to get a hold of that. So the big challenge is, how can we stay relevant, keep the lights on over the next 9 months, which may be a challenging period in the market, to still be here when the boom time comes, because we're going to see all of these projects coupled with now increased production. You know, ADNOC now coming out of, or UAE coming out of OPEC, you could see production go up 5-6 million, and they have got the scale to bring that on fairly quickly as well. So the biggest challenge, not surprising in the findings, is that caution just now, you know, making sure the right decisions. And some companies have got the deeper pockets and realise, or the investors that are backing them, knowing that perhaps for the next few quarters they're going to be rough, but we will make this up going forward. Other companies maybe don't have that luxury and are having to right-size the business, see through that turbulent time that may be expected. However, we may see us bounce back a little bit quicker. That's one thing this region is very good at, is bouncing back quicker than many people anticipate.
And Kim, on this issue of trying to keep going and grow the business in this incredible period of uncertainty, you actually run an event every year called Bankable Energies in the UK, which looks at how investors make decisions, particularly focused on bringing renewable energy and energy transition projects to life in turbulent times. So you've probably got a pretty good perspective on what's going on there.
I would agree on the cautious tone that comes with that growth message from this year's findings. And the conversations I had with members around those particular sort of questions on what are your projections for future years, there was often a bit of a sense check there in relation to the risk of projects moving out to the right. Talking to what's happening, what's on their order books and their backlog, there are elements that they are quite positive and quite optimistic about. But I guess they also have a realistic side, which they've seen in previous years when projects have been delayed for various reasons. So I would agree that the resilience piece is being key in terms of businesses, in terms of achieving previous sort of growth figures. And I think that, to Ryan's point on the right sizing of businesses, many are operating, you know, they're very lean at the moment and they're agile and having to react quickly to the changing market conditions. And I think that resilience that they've built as part of that is supporting the growth projections, but I do think that it comes with a cautious tone from those that I spoke to.
I think that's a way to look at it. We have three categories in the analysis which link to this. As you say, transformation, which you mentioned before, is up 24% in companies took the chance to transform this year or last year. Optimization is up, so this is improving costs and process in their businesses to, again, 90% of companies focused on that. Resilience up, 18% of companies really focused on their resilience. So I think you make a good point there. So, okay, let's come to the last point, which is in this global race for dominance and power-based politics, Europe seems to be falling behind. And not only do we see that in some of the statistics, but generally in the feedback. We've got high costs of energy. We're falling behind on achieving our net zero targets. We were impacted the most by the vulnerabilities of the war in the Middle East and not being able to get jet fuel, fertilizers, and so on. I would say impacted most, as well as some areas of Asia that were equally impacted. And a general sense of losing the economic race with an accelerating deindustrialization being the outcome we're seeing in Europe. Kim, on this one, it's not a very happy story, but it's what the data seems to show. What are you hearing from our members about this? And obviously, we now have something called the Directorate of the Energy Supply Chain, which is all about converting what we're hearing from our members into advocacy work to get these urgent problems communicated to policymakers.
Maybe start with the position and the landscape in Europe and include the UK within that. It is challenging. And I would say that I don't recall many companies talking about their focus increasing or entering into new areas in Europe, or for that being an area that they were particularly focusing on for their business. Those regions that came up time and time again in terms of areas they were focusing on, Middle East, South America, I recall coming out quite strongly for the companies, as well as parts of Asia. And they're areas where there are buoyant markets, strong conditions to do business, ease of doing business often referred to in the fact that companies felt like some overseas markets for UK companies were actually far easier to operate in, with less barriers, hurdles, perhaps less red tape and quicker turnarounds. They could do business far easier in a quicker manner. And my first interview was very much focused on that, around how for them to expand their growth. In this particular case, North America was exceptionally easy in comparison to doing business in the UK. So you're quite right. The business conditions that organisations find themselves in ultimately are core to how they focus on particular regions. And the process of Survive and Thrive this year was actually really, really great timing for us. As you mentioned, the Directorate for the Energy Supply Chain is a C-level initiative and committee that we set up here in the UK just earlier this year, welcoming leaders from member companies to share their views around deindustrialisation of the UK so that we can help shape our policy and advocacy work to support the challenges that they come up against. And we've touched on some of those challenges already in part of our conversation today. You mentioned local content. That was particularly topical at a recent meeting for members of the committee that we had together. So I think for us in our role at EIC, helping to raise the voice of members around those challenges, when it comes to policies and the impacts that it has on the energy supply chain is key. And hopefully by gathering those views, we can help alleviate or ease some of those challenges that members come up against. I think there's a definite drive for stability in policy and also a focus more on supporting businesses here in the UK, winning, as we've mentioned, on local content.
I have some stats on this that will be in the report. So the top 5 policy requests from companies in the UK were provide long-term policy stability, support domestic oil and gas, invest in skills in the workforce, work in partnerships with small, medium-sized enterprises, and deliver clearer, faster regulation. In terms of continental Europe, the top 5 policy asks were reduce bureaucracy and harmonise regulation, provide long-term policy stability, combat deindustrialisation and support local champions, invest in infrastructure and clean energy, and enable talent mobility and skills development. They're really interesting. So Ryan, let's come to you as a kind of wrap up, really, from this point of view of Europe really losing the sort of global economic race. Now, you sit in the Middle East and represent our members in the Middle East, Africa and CIS. What's the view of the members there about a lot of their headquarters of the companies based in the Middle East that probably are in Europe and the UK, but also about Europe as a market?
Yeah, so interestingly, over the last few years, many of them are probably now doing more business revenue out of the Middle East. So Europe where historically they were headquartered and probably had a bigger headcount, not necessarily the case now. So there's that move, that drift towards the Middle East. There's more structured growth. So we've touched upon earlier about the resilience they're wanting in, not just the headcount through your in-country value. They're wanting to do more manufacturing. They're looking for you to have more meaningful relationships within the country. So mainland Europe, you're not really seeing a huge amount there. It's mostly focused on growing the business in the Middle East region. And then perhaps something that really struck me during the conflict was that the members who perhaps had slowed down here pivoted more to Africa or to Asia than looking back to Europe. These were seen as growth markets for them. And even now, the work that you're going to see is more about building resilience into the country, looking at alternative transport routes, the asset rehabilitation that's going to come in to try and prevent where possible, but if not, increase the safety and security of assets as well in the region. So I think this has been a journey for a while. For me, it's, if anything, being accelerated away from the European market and focusing more on a domestic Middle East market. But that pivot during the conflict to Africa and Asia was probably quite telling in itself.
So the top 5 findings for members and their policy asks members based in the Middle East. Number 1, drive export-led industrial growth, but obviously not to the European market, seemingly. Protect in-country value and talent. Of course, that wasn't even mentioned in Europe and the UK because it's deemed as not even legally possible in many countries of the UK, strangely. We need to do some work on that, Kim, separately, don't we? And then fund practical technology deployment, not mentioned in Europe and the UK. Develop transparent, stable regulation. Okay, some similarity there. And finally, mandate technical sovereignty. So this is about countries like the UAE and Kingdom of Saudi Arabia wanting to attract licensed technologies into the region to be then built there and then exported from there. Totally the opposite of what has been happening recently in the UK. So it all starts to make sense. Anyway, so Kim and Ryan, thank you so much for your really valuable contribution in trying to make sense of what's happening right now, bringing us up to date. Obviously, the reports will be published on the EIC website. And you'll get more information in the notes to this podcast if you don't know how to get to the website. So final thoughts, Kim.
For the companies in the UK that took part this year, the resilience is key. We're operating in challenging times in the UK. Companies are supported by EIC and others in terms of accessing that export sort of growth opportunity. And once again, I would say that the people are at the heart of all that our member companies are doing, and whether they had a people story or not, that was very strong in almost every interview I did, and how much they value their people and the expertise. And my final takeaway for those listening might be, if companies haven't previously participated in the process, definitely sign up to take part next year.
Absolutely. We want all our members, so it should be 1,000 companies doing Survive and Thrive every year, not 136, although that's slightly scary for us who would have to do all the interviews. But please do give us the problem. And just on the export point, it's important to state that people might be thinking, well, hang on, how can there be low export growth in new markets and yet the strategy is exports? Of course, the strategy is exports to existing heritage markets. It's the development of new markets that is just going so badly. And Ryan, final thoughts from you.
First of all, one thing that stood out was the quality of the stories this year. I thought some really excellent insights provided. I think the companies are understanding this report and really free with their insights. So like Kim, I'd encourage people to participate and read this year's report as well. The second one was probably more the resilience and optimism that was built in, because during the course of the interviews, the conflict was going on. So that is reflected throughout the 3-4 months that we were doing. But the sense of optimism didn't wane from the first to the last interview as well. And that, for me, is a real big key takeaway and is probably reflective of the Middle East energy market as a whole, the amount of resilience that's been built in. And really excited to see what the findings are next year as well, because I do feel that at that point we're going to be in very much a boom time across the Middle East.
And thank you, Ryan, for saying that. So I think resilience, but also loyalty to the region, right? We've heard said by many leaders in the Middle East during the conflict that those countries and companies that stand by them in these difficult times times, those that are regarded as friends for the future, those that walk away in the difficult times will not be given the same level of opportunities as those that are regarded as friends. So we as EIC remain completely committed to supporting the Middle East. And an example of that is ADIPEC, which is coming up in November in Abu Dhabi, which is the world's biggest energy show. And we will expect to have our biggest ever UK and EIC pavilion at that show. And we're expecting all of the sort of things we've talked about here to be discussed at that show. So perhaps that's where we'll see many of you next. Kim, Ryan, thank you so much.
Thanks, Stuart.
Well, that's our show for today. A huge shout out to Samara, Lucas and Joao and the rest of our incredible team behind the scenes. This show truly wouldn't happen without them. If you enjoyed this podcast, it would mean the world if you'd hit that follow button, give a 5-star rating or leave a review. It's the best way to help us keep doing what we love. And as a thank you, I'll leave you with my favourite 5-word joke. Love wind power. Big fan.